Right now, half of the internet's screaming that AI is the biggest bubble in history. The other half screaming that it's the biggest breakthrough since sliced bread. And honestly, I avoided making this video for a long time, mostly because AI is the only thing anyone talks about anymore. But the longer this debate spiraled, the clearer it got to me that both sides were arguing about the wrong thing entirely. It's reached a point where I felt like I couldn't just sit back and watch anymore, so here we are. Because the uncomfortable truth is that it doesn't matter which half of the internet is right. Both of them are watching the wrong thing entirely. They're missing what's hiding in plain sight. Everyone in this fight is arguing about the same thing: user growth, adoption, revenue, how many people are using this stuff. They're all just arguing about demand. But demand is also the side of the coin that can lie to you. It's noisy, it's narrative-driven, and it's a story that changes depending on who's telling it and what they're trying to sell you. But every coin has two sides. And the other side, the one nobody's talking about, is the side that paints a much better picture of what's actually unfolding. It's what the world's best investors have quietly used to track financial bubbles for more than 200 years. And it starts by looking at the other side of the coin: supply. Because demand can be faked, and we'll get more into exactly how that happens a bit later. But you can't fake supply. Supply takes real capital, committed up front, and it tells the real story of what's happening. This year alone, the biggest tech companies in the world are on track to spend around $725 billion on artificial intelligence. And when most people hear a number like that, they usually just scroll right past it, without ever stopping to picture how much money that actually is. Because $725 billion isn't just a big number, it's an almost incomprehensible amount of money. To put it into perspective, if you spent $1 million every single day starting from the day Jesus was born, all the way through the fall of the Roman Empire, the Middle Ages, the Renaissance, both world wars, and all the way up to today, you still wouldn't have spent as much as big tech is projected to spend in AI in just this year. It breaks down to roughly $2 billion a day, $83 million an hour, or about $23,000 every second. In just the time you've spent watching this video, big tech has already spent more than $3 million on artificial intelligence. We've never seen a bubble of this size before. But as Mark Twain put it, history doesn't repeat itself, but it often rhymes. And what we're seeing right now is very familiar. The real question isn't whether AI is going to change the world or not. That part doesn't actually really matter. Financial bubbles aren't required to be built on bad technology. In fact, most of the time, it's the opposite. ResearchGate looked at 175 years of major breakthroughs from 1825 to 2000 that included innovations like the television, the automobile, and the internet. And they found that 37 of the 51 major breakthroughs in technology triggered a massive speculative financial bubble. As billionaire investor George Soros said, "Stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality is distorted by a misconception." If you look throughout history, it's the same pattern repeating itself over and over, and it always ends the same way. Which is why the best investors have stopped watching the demand side and started watching the supply side. Because when you follow the paper trail, you get to the truth. It starts with a framework that is rooted in some of the oldest ideas in economics, going all the way back to Adam Smith in the 1700s. The increase of stock, which raises wages, tends to lower profit. When the stocks of many rich merchants are turned into the same trade, their mutual competition naturally tends to lower its profit. And when there is a like increase of stock in all the different trades carried on in the same society, the same competition must produce the same effect in them all. When Adam Smith says stock, he is referring to capital and productive assets. So translate this out of 1700s powdered wig talk, and what Adam Smith is really saying is that money naturally flows into industries where there are perceived high returns, which means more competition enters, which ultimately drives returns down for everyone in the industry. And this idea has been modernized and expanded upon into a framework with a new name, the capital cycle theory. It ignores the noise involved with demand and just focuses on what actually matters, the capital flowing through the supply side of an industry. And after I explain how it works, you'll start to notice the same patterns repeating across stock market bubbles throughout history. The capital cycle moves through an industry in 4 steps. First, the flood. A new technology shows up, the returns look sexy, and capital comes pouring in to chase them. Step 2 is the boom. Money keeps pouring in, competitors pile in faster than the demand can grow, and the more everyone builds, the more the returns start to slip. Step 3, the collapse. All that new supply finally crushes the very returns that attracted it in the first place. Prices fall, companies fail, the industry consolidates, and a lot of people lose a lot of money. And finally, the inheritance. This is where the real money gets made. Capital flees the industry, the builders go bankrupt, and somebody walks into the wreckage, buys the assets for pennies on the dollar, and collects the value the original builders in the industry paid for. That's the capital cycle theory. The idea is simple. Returns are driven by supply, not demand. The best opportunities show up where capital is fleeing, the worst where it's flooding in. And if you go back through history, you'll see the capital cycle showing up again and again. But before I show you, here's Oaktree Capital co-founder and billionaire investor Howard Marks, breaking down how history repeats itself in the markets.
Most people ignore history. Most booms, and I've probably lived through about a half a dozen real booms in my 50 years in the business, are usually about something new. And the internet in 99, the Nifty 50, Xerox in 69, whatever it might be, subprime mortgage securities. And the people who get excited about it, who cotton to it, who are intoxicated by the positives and willing to ignore the negatives, if you say to them, well, that happened 20 and 40 years ago and it ended badly, what they say is they use the 4 worst words in the world. It's different this time. The rules of the past don't apply. Yes, the average PE ratio historically has been 16, but now it's 32, and that's okay because the internet has changed the world.
So let's rewind to one of the earliest examples of the capital cycle theory playing out from start to finish. Take yourself back to the 1830s. The first industrial revolution is in full swing in Britain. Mines and factories need to move coal and iron faster than horse-drawn wagons allow them to. Then new railway technology shows up and changes everything. And where excitement is, the money follows. This is the flood. Capital poured into anything with the word railway attached to it, and not just from bankers, shopkeepers, clergymen, widows, all of them piled into railway stocks because nobody wanted to be the one who missed out on getting rich. At its peak, railway investment hit around 7% of the entire British economy. In a single year, Parliament passed 272 separate acts just to authorize new lines. Then came the boom. Companies stopped building the railways the country needed and started building whatever they thought would push their share price up. Routes got duplicated, lines got run out to villages that would never fill a single train. Then a reality check came when the new lines were bringing in only about a quarter of the revenue investors had been promised. And once that was undeniable, the math caught up all at once. By 1850, the collapse was in full effect, and the British Railway Index saw its shares being worth less than half their peak. Fortunes that had felt permanent were simply gone. And then the last step, the inheritance. The original investors got wiped out, but the rails they had bankrupted themselves laying were still sitting in the ground. Over the following decades, that network became the backbone of the entire British industrial economy, and the people who got rich were the ones who scooped those assets up for pennies after the bubble burst. That's the capital cycle from start to finish. Flood, boom, collapse, inheritance. Money flooded toward the shiniest new industry, certain that's where the best returns were, until all the competition led to oversupply, returns getting crushed, and the people who supplied the boom were destroyed by the very supply they created, while the value they paid for was left for whoever showed up after the crash to snag for a great price. But while the top hats and mutton chops make it easy to dismiss all this as a Victorian problem we would never fall victim to now, that couldn't be farther from the truth. Jump all the way to the late 90s, and we can see the same cycle play out again. After the US rewrote its telecom laws in 1996, the flood poured into fiber optic cable. Carriers buried more than $500 billion of it, around 80 million miles, across the country and under the oceans. But then the hype started to fade, and reality caught up. Around 85% of all that fiber sat in the ground completely unused. Bandwidth prices fell about 90%. The NASDAQ fell more than 70%. And Corning, one of the largest fiber makers in the world, watched its stock go from over $100 a share to about $1. And funny enough, Corning over the past year has become one of the hottest names in AI right now, and their stock chart looks awfully similar today, as it did back in the early 2000s. If we fast forward another decade, we see the pattern play out again in oil. Innovations in fracking unlocked massive, previously inaccessible reserves. Capital flooded in, drillers came chasing all at once. US oil production roughly doubled, and the US became the largest oil producer on Earth. And then the supply blew straight past the demand. Between 2014 and 2016, the price of oil collapsed from over $100 a barrel to about $30. More than 200 North American oil and gas companies went bankrupt, the borrowers drowned, and the cheap energy they left behind got picked up at a steep discount. So railway mania in the 1840s, fiber optic cable in the late 90s, and shale just over a decade ago. 3 different centuries, 3 different technologies, 3 completely different industries, nothing in common except one thing, the exact same cycle playing out underneath all of it. Which brings us to the biggest one yet, the one our entire economy is currently clinging onto for dear life: artificial intelligence. This is the one that matters the most, because when the other 3 collapsed, they took down some investors and a couple of industries. But artificial intelligence right now is holding up the entire economy. And now back to how the entire United States economy has quietly become dependent on one massive bet. A Harvard economist named Jason Furman ran the numbers, and in the first half of 2025, he found that investment in information processing equipment and software, which is the AI build-out, was only about 4% of GDP, but it accounted for roughly 92% of all the growth in the US economy. So if you strip the AI build-out from the equation, the US economy only grew at about 1/10 of 1%. So where does AI sit inside the capital cycle? Well, the money is still pouring in, but if you look closely, there are cracks starting to show. Remember when I said you can fake demand and that we'd come back to it? This is us coming back to it. In the 90s, they faked demand with a story. WorldCom stood up and said internet traffic was doubling every 100 days, and the whole industry ran with a number that was never real. This time, they're not faking it with a story, they're faking it with money. You've probably seen this chart that looks like a circuit board. Every name on it is one of the biggest companies in AI, and every arrow is money moving between them. A purchase here, an investment there, a loan over there. And if you follow almost any arrow, it loops back to one place. NVIDIA funds OpenAI. OpenAI pays Oracle. Oracle buys NVIDIA chips. The money makes its rounds throughout the industry and eventually comes home to NVIDIA, and every time it passes a hand, it gets counted again as somebody's brand new demand. So a lot of what looks like a booming market is really just the same money going around in a circle. If this sounds familiar, it should. The fiber bubble ran the same trick. Equipment makers like Lucent and Nortel lent their own customers the money to buy their gear, then booked it as revenue. Activist hedge fund and alternative asset manager Buxton Helmsley clocked this immediately. They noted that vendor financing did not merely add risk at the margin, it manufactured the appearance of end demand. Equipment sold to customers who could pay only because the seller had financed them was recognized as revenue, validated growth narratives, and supported valuations, until the moment the sellers could no longer extend credit. So that circle can do a lot. It can manufacture demand, prop up revenue, and keep the chips moving. But there's one thing it can't do. It can't escape the ideas Adam Smith laid out about money chasing high returns, competition entering, and returns getting compressed for everyone. And the best place to look for returns slipping is in the eye of the storm, OpenAI. 2 years ago, OpenAI basically was AI. ChatGPT had no real competition, then everyone showed up. Google, Anthropic, Meta, xAI, a dozen others, all selling more or less the same thing. It's the boom arriving, right on schedule. Then last year, OpenAI's financials leaked. For the first time, we could see what that competition did to the hottest company in the world. And it's ugly. OpenAI lost $38.5 billion in 2025, nearly 8 times its loss the year before. But the real story for OpenAI isn't just in the headline number, it's buried a few lines down. When you look at what OpenAI had to spend on sales and marketing, it jumped more than 400% in a single year to $5.7 billion. That's 44% of their entire revenue spent just to keep people using the product. That's the cost of the boom. The returns are falling, exactly the way they fell for railways, for fiber, and for shale, which means you already know what comes next. And we're already seeing early signals of it throughout the industry. In early June, a chipmaker called Broadcom beat its earnings, but guided its AI sales for the next quarter a few $100 million light. For a company worth nearly $2 trillion, that should barely move the needle. But following that news, about $300 billion of its market value vanished in a single session. One of the biggest single-day losses in Wall Street history, over what amounts to a rounding error for a company of Broadcom's size. That's the tell. When a few $100 million in soft guidance can erase $300 billion in a day, you're not looking at a healthy market. You're looking at one priced for perfection, where being even slightly less than perfect costs you more than $250 billion. There's an old line in business: the pioneers get the arrows and the settlers get the land. It means the first companies into a new market take the hits, the risk, the losses, and the resistance. Then the later arrivals walk in after everything has stabilized, the dust has settled, and quietly take the prize without ever taking the arrows. You've watched this happen in front of your eyes for your whole life, whether you realize it or not. Take search. In the mid-90s, AltaVista, Lycos, and Excite were the pioneers. They spent millions building the first web crawlers and teaching the world what a search engine even was. Then they buried their pages in news, email, and banner ads chasing revenue to pay for it all and let the actual search product decay. Then Google walked in, didn't repeat their mistakes, and took the land. Or rideshare. Before Uber and Lyft, a company called Sidecar spent its life getting sued by cities and blocked by taxi commissions, fighting the legal battles that made the model possible. And while it was stuck in court bleeding cash, Uber and Lyft copied the model, raised billions, and took over the world on the foundation Sidecar had built. There's countless other examples of this. It's the capital cycle theory. The first movers flood in, prove the market, and pay for it with everything they have, then eventually get taken down by the arrows. The supply they built gets left behind for the settlers, where the second movers walk in and inherit it for pennies on the dollar. Which brings us all the way back to where we started. Everyone is staring at one side of the coin, the demand side, screaming about whether it's real. And it's easy to see why. The demand side is loud, it's a story, and a story is what gets clicked. Traditional financial media will keep you locked on that side for exactly that reason. But in finance, the side that actually decides what happens is never the loud one. It's the quiet mechanics underneath that drive everything. If you want to track that side instead of just following the noise in traditional media, hit subscribe. Once you understand the cycle of how capital flows through industries, the whole fight everyone is having online looks like the wrong fight. Bubble or not was never the right question. The question was always who floods in, who drowns, and who inherits. Once you start asking the real questions, you start getting to the real answers.